The IRS doesn't give gifts, but there's one account that they've had on the books since 2003 that comes pretty close, and most people walk right past it. And even of those that don't, almost no one uses it to its maximum advantage. So today, we fix that. We're going to be talking about the no tax retirement account that most people miss, what it is, how it works, and the strategy that turns it from a modest perk into one of the most powerful tools in your retirement plan. My name is John Norberg. I'm a certified financial planner and the owner and founder of Norberg Wealth Management. And with that introduction, allow me to welcome you to this latest edition of the Financial Prof series. So there's an expense I've seen working in this field for years that most retirement plans tend to underestimate, sometimes quite vastly. Fidelity, you see, estimates that the average couple retiring today will spend close to $300,000 on healthcare costs after the age of 65. Not long-term care, I'm talking just routine medical expenses. Premiums, co-pays, prescriptions, dental, vision, and that bill's going to show up every year with the punctuality of a landlord and the warmth of an audit, right? But when I sit down with people in their 50s and 60s and we go through their retirement projections, healthcare is almost always the line that's either missing or badly underestimated. You see, I field questions constantly from people who are all but ready to cross that line into their retirement of their dreams, if they could accurately answer the question of healthcare. They'll plan carefully for housing and for travel and for what they'd like to leave to their children. They'll get into the tax plan to minute detail. But then they get to healthcare and they feel, well, to put a darkly humorous spin on it, paralyzed, right? And yet, there's an account that's specifically designed to meet that cost, tax-free, on your terms. And I'll show you exactly how in a moment. But first, you need to know whether you qualify, because there's a definite clock on this. By the way, if you or someone you know is in this boat right now, feeling paralyzed about retirement because of the unknowns of healthcare costs in retirement, I would love to help bring clarity to you or your friend. Click the link below to book a free consultation, and we can talk through your specific questions on this or any other topic that has you hesitating about your retirement plan. Because here at Norberg Wealth Management, we love to help people get to where they're going by bringing clarity to their situation. So, what is this mysterious, magical account that is triply tax advantaged and that could potentially help us solve all of these problems, or at least a good number of them? The account is called a health savings account. Yes, that's right, an HSA, and you've probably heard of this account before, but even if you have one and have for some time, the question is, are you using it to its maximum advantage? Well, we're going to answer all of that. So first of all, to contribute to an HSA, you need to be enrolled in a high deductible health plan, what's called an HDHP for short. These are health insurance plans with lower premiums and higher deductibles, and they're widely available through employers in the individual market. Now, here's the thing. If you're on Medicare, you can no longer make new contributions, which is why this conversation matters most to people who are in their 50s and early 60s before Medicare begins. The clock I mentioned is a very real one because once you enroll in Medicare, that contribution window, aka the ability to make this account grow by putting your money into it, is closed forever. Now, the 2026 contribution limits are $4,400 for individuals and $8,750 for families. If you're 55 or older, you can add an extra $1,000 on top of that as a catch-up contribution. Now, those numbers are useful, but they're not the reason that I'm making this video. The reason is what this account does with your money once it's in there. And that is where things really start to get interesting. You see, most people, when they use an HSA, they'll contribute to it over the years, and sometimes, frankly, I've even seen people forget about it, which is unfortunate because it's, as I mentioned, one of the most powerful tools out there in your retirement tool belt. But here's what makes the HSA different from every other account in the United States tax code. Think about a Negroni, right? Famous classic cocktail came about in the 1920s, but for the uninitiated, it consists of 3 ingredients. It is that classic 3 equal tripartite cocktail. It's got gin, Campari, and sweet vermouth. Each of these are distinct ingredients with an interesting tang on their own, but combined in the right proportion, they produce a thing that is truly greater than the sum of its parts. If you remove any one of these three, you don't have a lesser Negroni. You have a different drink entirely. And the HSA actually works pretty similarly, right? Part one is you put the contribution money in and you get a tax deduction on it. Money goes in pre-tax just like a traditional IRA or 401k that you're no doubt familiar with. If you're in the 24% bracket and say you just contribute 8750 as a family, you've just saved about 2 grand in federal tax immediately before the money does anything. Now part two, that growth is tax-free. Most people leave their HSA in a cash account earning next to nothing, but nearly every HSA allows you to invest the balance in index funds, ETFs, the same vehicles you'd use anywhere else. And that growth accumulates entirely free of tax. No annual capital gains, no dividend tax, nothing, right? And then the third part, withdrawals for qualified medical expenses are also completely tax-free, not tax-deferred like an IRA, not tax-advantaged in some technical sense. I mean tax-free. You built it pre-tax, it grew tax-free, and you get to spend it tax-free. The IRS collects nothing on that entire journey, and no other account in the American tax code does all three. The Roth IRA gives you two of the three, tax-free growth and tax-free withdrawal, but contributions are after tax. The traditional IRA will give you one and defer the rest, but the HSA, used correctly, gives you the full Monty. And here's what I want you to go ahead and hold on to as we get into this strategy even further. Knowing the three tax advantages is necessary, but it's not sufficient because the way that most people actually use their HSA captures maybe one of those three. And the strategy that I'm about to show you captures all three of them. So listen in, because again, this is where most people get it wrong. And once I open their eyes to how they can actually maximize it, it's like seeing scales fall from the eyes of the converted. So, how do you actually use an HSA to its maximum advantage? Well, first let's talk for a second about how most people use it. They use it, frankly, like a debit card, right? They'll put money into the HSA, and the moment a medical expense appears, a prescription, a copay, a simple dental bill for a checkup maybe, they'll pull the money straight back out. Now, that is okay, but it also means that the account really doesn't have much chance for growth. The investment never compounds. They've captured the first tax break, which is the tax-free deduction, the deduction on the money going in, but they've left the other two sitting on the table. And when you and your family were younger, perhaps this strategy made a lot of sense. Kids, after all, as I can personally attest, are both injury-prone and expensive, and maybe you needed to pull the money out right away. But especially as you age into, kids getting older and hopefully slightly less injury-prone, the strategy is a little bit different. You pay the bills out of your pocket now, and you leave the HSA untouched. And here's what makes this legal and remarkably powerful strategy really work. So if you get one thing out of this whole video, let it be this. There's no time limit on HSA reimbursements. The IRS doesn't require you to reimburse yourself the same year the expense occurred, which means you could pay a medical bill today, keep the receipt, and then reimburse yourself from your HSA 5, 10, 15, 20 years from now, tax-free, after the account has had ample chance to grow. So think about what this means in practice. For example, if you contribute and invest, let's just say $87.50 per year as a family at age 55, you earn 7% assumed rate of return. By age 65, you have over 120K in your HSA. Then you begin drawing down that money over the years, all tax-free because you've kept the receipts of everything that's happened medically in between. Things have compounded beautifully. But here's a second mistake, leaving that balance in cash. Nearly every HSA provider offers you investment options, target date funds, ETFs, mutual funds. The moment your balance exceeds a modest threshold, typically $1,000 to $2,000, the rest should be invested. An HSA sitting in a money market account is not an HSA that is working at its full capacity. And one more use that's worth knowing. HSA funds can be used to pay Medicare Part B and Part D premiums tax-free. And if you're in the pre-Medicare stage looking for a way to bridge that gap, HSA funds can also cover COBRA, that continuation of health insurance from your job. The account that started as a workplace benefit thereby becomes a bridge across one of the most expensive stretches in your life. Now, there's one more dimension to this account that most people unfortunately discover too late. What happens to the money if your health holds and you don't spend it at all? And the answer might surprise you, and it's part of why I think of the HSA not as a healthcare account specifically, but as a retirement account that happens to be particularly good at healthcare. See, after age 65, you can withdraw from your HSA for any reason, not just medical expenses. Non-medical withdrawals are taxed as ordinary income, just like a traditional IRA, which means that the HSA, in the absolute worst case, if you never need it for healthcare or health-related expenses, simply becomes another IRA for all intents and purposes, with the triple tax advantage already banked on every dollar that you've already put into that HSA. And that's the part that I think a lot of people just miss entirely, because unfortunately they don't know about that after 65 clause. So if you think about it kind of like another IRA, even though it's not technically, sitting alongside your other retirement accounts that you can use on, again, anything, it's really powerful, especially if you are using it maybe on some healthcare, some other expenses. But let me go ahead and come back to where we started. The IRS doesn't give gifts, but the HSA is about as close as they get. A triple tax advantaged account where every part of that journey, in, through, and out, can work in your favor from a tax perspective. It's been there since December of 2003, and most people have had access to it for years, but very few of them use it the way that we describe today. T.S. Eliot once wrote that we shall not cease from exploration, and the end of all of our exploring will be to arrive where we started and know the place for the first time. And that's what good financial planning often feels like. Not the discovery of something exotic or inaccessible, but finally seeing clearly what was there and being able to truly enjoy and appreciate it. And the HSA was always there. If you're in your 50s or your early 60s and you're not yet using one, or not using it the way we've talked about today, the window is quite likely still open for you. But as with most things in retirement planning, the earlier you act inside of that window, the more that compounding works in your favor. So if you'd like to take a look at how an HSA fits in your specific retirement picture, or if you're still struggling to answer the healthcare and retirement questions in general, and how that fits into your overall plan, I'd be delighted to spend 30 minutes with you going through the numbers. No pitch, no agenda, just clarity. You can book a complimentary call, as I said, through the link in the description below. And if this video was useful, please subscribe. It's the best way to make sure you see what comes next from the Financial Prof. And in the meantime, I'll see you out there.